Hey, Sovereign Wealth Builders, Simon Dixon here, and welcome to another episode of Simon Dixon Hard Talk Live. We are in week two of the Iran war, and of course, we're going to be covering everything as the global reset continues. And it looks like this week, Russia is quietly winning. So, we're going to be covering that and breaking it down into two parts today. Firstly, I'm on the move a little bit, so I've got my temporary setup. We're not in the studio this week, but the show must go on. And so, in part one, I'm going to be covering everything you need to know about what happened in week two of the Iran war. We covered everything in last week, and what to look out for. We'll be reviewing what we predicted, what's happening, and what the markets are telling us is going to be happening next. And this is all as a result of the Strait of Hormuz oil shock and what a shock it is. We're going to make sure you understand it and how to interpret it. Then in part two, as usual, I'm going to make sure that you've got one of the interviews that I did this week, and that is on really the financial war behind the Iran conflict and how it relates to my theory around the military industrial complex and the financial industrial complex managing this transition, what the end result will be. And that was done on BT Sessions, where they interviewed me this week, and we'll make sure that you get the interview live so that you can combine it with everything that's happened this week as well. So without further ado, let's jump straight into part one. Iran war, week two, the Hormuz shock, and really, it was a shock. Now, part one, really, we were asking in week one, the market didn't quite internalize, and I think it underreacted because it wasn't quite sure whether this was going to be some kind of Venezuela operation, or whether this was going to be long term, or whether this was going to be a managed conflict. And so week one was really just about, the shock phase of, right, this is happening. It was leading up for a long time. We've been covering it for ever since Trump was the Trump election and the Biden election. If you remember, during the Biden-Trump election way back, seems like such a long time ago, I was saying, I'm sure Trump is going to be made the president because he was the chosen one in order to deliver the Iran war. And then over time, we covered the 12-day war, where I didn't predict that that would actually happen because it looked like we were moving to that transition. But we entered into what I called a theatrical war. And if you go to my blog on simondixon.com, you can see all of these things. I record it every single week and make sure that you can go back to those if you choose. But I covered the 12-day war play by play and understood this to be a three-way theatrical victory that had very specific goals that I believed was a negotiated outcome between the factions of power. Then we move over to what is now the phase two. And so I've been saying that there would be another 12-day war. Now, when we covered it last week, I admittedly said this was way more and moving way faster than I originally predicted, which means that the managed transition to a multipolar world, I believe, is actually being managed and happening in real time. And this will be the final phase. After this, there will only be the negotiated outcome, and maybe there's additional derailing of the plan based upon additional factions of power. But I believe that everything that needs to be resolved is being resolved in this phase. Now, in week two, we got to see the most important thing beyond the bombs, beyond the missiles, beyond the enforcement of the closure. That was the shock and awe that happened in week one. Week two was really about the markets and how they're going to start pricing in the limits of the conflict. Is it going to start pricing that this is a long war? Or is it going to start pricing that this is World War III? Or is it going to start pricing that those that know what's going to happen next, or those that are betting big money on what's going to happen next, are the ones that really go beyond the talk? Because the market tells us what the market is thinking as well. So I'm going to be diving deep into all that. and going through the limits of the conflict, and that really this is not just bombs and missiles at this phase anymore. It is really, about energy systems and infrastructure and what it means when certain energy systems and infrastructure are closed down. Then you need to look at what the media is covering, what the media is not covering, and what the alternative routes are, and how that's being factored into the market. So, really, then it becomes what are the supply chains telling us? What impacts, what second, third, fourth, and fifth degree impacts come from this? And we can tell by looking at the financial markets. We follow the money, as we always do. And so the question that the market is trying to ask right now and have answered is this a total global breakdown, as the closure of the Strait of Hormuz certainly can be and is? Or is this a controlled and managed crisis based upon this managed transition to a multipolar world that I believe is predominantly being fed and executed by the financial industrial complex in cooperation with the Gulf sovereign wealth funds and China, that also has influence over the more pragmatic elements of the IRGC and the reformist elements of the Iranian government. On the other side, you have the military industrial complex, which is aligned with the neocons in America, the more hardliner elements of the IRGC, and radical Zionist warmongering within Israel. Those are the two different factions of power. I believe that finance wins in the end because they control the flows of capital, and they have negotiated a big theatrical war that also leads to lots of profits and very key strategic goals being met, while the military then goes over to its next conflict zone in compensation, and the financial industrial complex moves into the profiting from the build back phase. And so this week, really, the Strait of Hormuz was effectively the center of the crisis. Now, there was lots of talks around whether it can be closed, whether it's not closed, whether the insurance markets closed it, what happened after that, and I covered all of that last week as well, and be covering this week. But effectively, let's just recap. What is the significance of the Strait of Hormuz? Well, basically, 20% of all global oil normally flows via this strategic choke point that relies upon two countries, mainly Iran and also Oman. And then there are naval fleets there from all sorts of countries trying to protect their interests, whether that be the Qataris, the Saudis, the Americans, the Brits, the French, the Chinese, the Russians, and the Japanese, the South Koreans, because all of those, the Indians, rely upon the safe passage through the Strait of Hormuz without disruption. If that doesn't happen, that impacts energy, but also liquefied natural gas, which is obviously electricity. But on top of that, there are also the fact that LNG is a vital part of petrochemicals, pharmaceuticals, and so that impacts the healthcare industry. And the initial market reaction was really focused on oil price spikes. And it was a wild market in terms of volatility. It really hit a panic level incredibly fast. And so what we had was oil, which previously was leading up to this war. It was around about the low of in the mid to late 50s. It went up to the 60s, and then it started as the war progressed going into the 70s. But immediately after the Strait of Hormuz, when the information was processed and the realization that America couldn't stop it, we had a peak price over the weekend where the futures market priced oil at $115. So it gapped up while the stock markets gapped down. We had the Asian markets, which were in the circuit breakers kicked in South Korea because of those energy reliant supply chains, as well as the vital components and rare earths behind what's needed for the semiconductor chip manufacturing industry, which then has impact on military, on AI, on electric car vehicles, on all and pretty much everything, electronics, consumer electronics, laptops, computers, phones, absolutely everything. But we suddenly had a sudden reversal this week. And it fell and crashed very dramatically down to about $89. And there were lots of announcements and lots of things in between, and lots of financial weapons that were fired in order to try and get that price down. So, what this initially did is it set a price ceiling at which price the markets consider it unacceptable, where they will use extreme measures to try and get the price down. This was a $26 collapse in one of the most liquid markets in the world. I mean, oil is really the backbone of the entire economy. If oil and energy and LNG don't flow, then the world as we know it grinds to a halt. It's all priced in dollars, with the exception of those that have been going through a de-dollarization campaign at the moment. But the fact that there was a $26 collapse in 3 days and the bulk of it happened very quickly, this was the largest price increase and decrease in the history of oil markets. That's how extreme this was. And so it hinges really in the historical prices of previous conflicts and what the price went up to. We've had peaks of about $135 on previous crisis, whether it be the Russia Ukraine conflict, whether it be the 1973 oil embargo during the Yom Kippur War, where Saudi Arabia constricted supplies as a result of Israel escalating the war. Whether it be the important point here is that we need to determine what real money is doing. Is real money exiting and placing crisis trades, or are the markets kind of signaling the limits of what they think this will be based upon insider information and kind of their understanding of what the war is and how long it will last? But then we've basically set this week an oil price ceiling based upon the escalation ladder that we saw this week. And what that means is that Iran attacked the US military bases, and then there were, taking out of, everything, all of the infrastructure that is needed in order to provide Israel's dominance in the region when they're executing their operations alongside the United States for the military industrial complex, the MIC. We also had strategic targets. Now, we don't know what was false flags. We don't know who potential candidates for false flags could be, but we do know, and we're going to answer who benefited the most. And really, we can look at Russia, Israel, and US as potential false flags. Iran was retaliating to US and Israeli aggression. Then there was the immediate reaction from Iran that targeted the US military bases across the entire region, including the Gulf countries. And then there was also a targeting of Oman, not on Oman as a sovereign nation or not on the Gulf countries as a sovereign nation, because they never retaliated, because they knew they were targeting US military bases. And the Oman side was to make sure that there was no alternative route through the Strait of Hormuz. And so by shutting off the Oman part, Iran had the full negotiation card and negotiation tactic, and we had the market reaction, and then we had a time frame of everybody that benefits from the closure to realign, put together their negotiations based upon the leverage. But as soon as oil hit above 110 to $120, we had massive intervention in order to try and reach this key equilibrium zone. So we know that right now, when there is LNG closed, where Qatar closed its production, when there is, kind of some targeting, whether it be false flag or not, of Saudi oil fields without destroying massive infrastructure. And by closing the Strait of Hormuz, we know that once oil hits $120, 115, $110, there is the desire and need to intervene because it becomes counter to the escalation cycle. Now, the tools that you have in order to execute that diminish over time. Some of those tools were Trump just make an announcement, the war's about to come to an end. It looks like we've reached an end to the conflict, and a post on Truth Social. But as it doesn't happen, and as it didn't happen, that enters into the taco trade. Trump always chickens out. And so as the taco trade becomes more normalized, the boy who cried wolf effect kicks in, and it becomes a tool that no longer works that effectively. But True Social was, where Trump was posting, and that really had an impact based upon that. Then there were real tools, not just optics. So you had the media, you had the announcements, you also had a reaction from Western G7 aligned, countries, and they all have strategic petroleum reserves. And some countries will have to use their strategic petroleum reserves, but everybody started hoarding. Energy prices go up through the roof. Everything had a reaction. And there was an announcement from the G7 countries that they're getting ready to deploy approximately 400 million barrels. So that was another tool that was used in order to drain those strategic petroleum reserves. That's what it's actually for. In fact, America was going to be draining, based upon the announcement, 41% of its strategic petroleum reserves. But it still wasn't as big as what happened during the Russia-Ukraine war from Biden, when he drained all of the reserves, and it got so drained that he had to run over to the Middle East, beg MBS to release some oil. And because the Biden administration didn't help Saudi previously, when the Trump administration struck Qasem Soleimani, and Iran reacted by targeting oil fields in Saudi Arabia via the Houthis. And MBS wanted America to get involved. Biden didn't get involved in that. And therefore, MBS decided to favor and work with OPEC Plus and Russia. That created a spike in oil prices before. Remember, the Fed very famously said this is transitory, inflation is transitory. That led to a spike in interest rates later, when inflation wasn't transitory. People were queuing, people were choosing between eating and heating. Prices went through the roof. And it also had cascading effects on the banking market, because there was that duration risk where essentially a bunch of banks had very low interest rate bonds that were the backbone. Peter Thiel came up on a space and asked all the Silicon Valley companies to withdraw their money from Silicon Valley Bank, creating a bank run. And then Silicon Valley Bank had to effectively sell all of their bonds to meet the demand for withdrawals. Now, those bonds, obviously, if you're hiking interest rates, then when the government's issuing new bonds, they have much higher yield. Because the yields are going up, it means old bonds, you have to pay a lower price if you're going to buy them on the secondary market. Now, you can hold them all the way to expiry, i.e., a $1 bond. If you hold it for the whole duration, you get the interest plus the $1 back, as long as the US repays it. But if you need to sell it in a panic, you get what the market will give you. And now, if interest rates are going up and new bonds are being issued at higher interest rates, then the price of those bonds go down. And this creates a structural balance sheet deficit for the bank, meaning they can't meet their withdrawals. And so that led to Fed intervention, FDIC exposure. It broke a bunch of banks. And then we had even the European banks like Credit Suisse go down, that then had to be merged into UBS. And we had to have a big print and, a form of QE type of intervention. Now, that those dynamics all exist again today. We're starting to see history repeat. We'll go into that. But where do they kick in? Well, they kick in effectively when oil now goes to that point of that 115 and $120, because what other tools did they use? They immediately, there was tools like um, lifting sanctions on Russia so they could sell more oil, intervening with futures markets. So Treasury would use their, trading desk or a covert operation like Jane Street, or something like that, in order to effectively go short the market using futures and options contracts. Now, the problem is that once you have those short suppression, you have a structural short position, and the price of oil has to go down before those contracts expire. Otherwise, you enter into a liquidation cycle where you borrowed some oil in order to sell it short to suppress the price. And then as those contracts reach expiry, if the price is very high, then you either lock in a loss and if the price is low, then you make a profit and the suppression works. But if we get some kind of action that spikes the price, then you have to pay any price in order to cover that short position, which is why the price then spikes up if those operations go wrong. So the more of this action happens, it either means that there's going to be a bailout to cover those positions, or it means that effectively they have some kind of information or some belief that by the time those contracts expire, the price will be lower, which means that the conflict has come to some kind of negotiation or decisiveness at that phase. So there is a real and genuine time frame on that. But once the price goes higher, they do whatever is required to get it down. Why? Because there will be an inflation shock, just like I described that happened last time during Russia-Ukraine. There would be a political backlash as countries are moving to elections, strategic reserves are kicked in. Countries like Thailand had to actually close and tell people to work from home. Now, people are remembering the lockdown from COVID cycle as well. And so people are saying, please preserve energy, work from home. That has a big political, ramification, particularly the Trump administration moving into midterm elections. He has legal issues, impeachments, if he doesn't win the midterm elections. So does that all kick in? Also, demand destruction. One of the ways of getting prices down is to make prices so high that no one can afford them. When nobody can afford them, only the wealthy people purchase, and the average people just choose between eating and heating, stop putting their heating in, stay at home, work from home. They find ways of reducing their energy consumption needs, and so do businesses. And that creates demand destruction, which pushes the prices down because less people are consuming it. And it also effectively, what is the market saying right now? Well, the market is effectively saying that the disruption is real. This is a real war, but the system is effectively designed to be able to absorb it. That's what the market is saying at the current, at the current things. The S&P was above 7,000 at new all-time highs. It's now around the 6,700 mark. That's a decrease, but it's not a major decrease. The Asian markets, they had massive gaps downs, and all foreign markets had more dramatical effects than the US market, which reversed that trade. Leading into this, we were getting a weakening of the dollar, where foreign currencies were outperforming the dollar, measured by the DXY, and also foreign stock markets were outperforming domestic US stock markets. That reversed as soon as the war kicked off because the impact is bigger because America is effectively energy independent, but it is the second and third impacts that need to be effectively absorbed here. But the market's absorbing it right now. We haven't had a major crash. And basically, there is some bypass of these different routes that the market, the media is not really talking about right now. But there is infrastructure that is effectively containing the price to a certain degree. And that is alternative infrastructure that exists within the Middle East. In fact, that is something that Saudi Arabia and UAE had. One of those, just to give you ideas on numbers so that we can really measure the real impact. Because the whole idea here is that we use the markets, follow the money, in order to predict what's going to come next on the war field as well. So there's basically a Saudi east-west pipeline where they're able to get about, it's basically about 750 miles. It goes across Saudi and basically it goes across the Gulf into the Red Sea, which is significant because we've seen during both the Biden administration and the Trump administration, they waged wars on the Houthis in Yemen that said they're not gonna open the Red Sea until Gaza and the genocide ends, and and they kept bombing. Now that led to the Biden administration launching a war against it with a coalition forces, the British forces, the American forces, and really nothing came from that. And Trump did the same, and nothing came from it. So they proven through air forces that they couldn't get the Red Sea open. Now that ended in a truce once the ceasefire happened, and Israel said that it was gonna. We had the 20-point plan, and that ended effectively. But that can kick off again. But right now we haven't seen that happen, which means that the Gulf countries via Saudi are able to get approximately at maximum capacity 7 million barrels per day via this alternative pipeline. Now, this is currently completely full at full capacity and has never functioned at full capacity. It was very much an alternative route. So, this is the first time that Saudi's been able to get 7 million barrels per day at capacity through this alternative pipeline. There are a few other bypasses which are less significant, but really it gives us an indication of why this price of oil is not at $150 or greater. There's something called the UAE ADCOP, and it's basically a pipeline that goes through via UAE. And there is an alternative one as well via the Strait of Hormuz, which is Iran has something called the Iran Gorge pipeline. And that's basically the Gorge to Jack pipeline. And there is also a way of getting oil via these alternative pipelines from Iraq through to Turkey, and then that can come out via the Mediterranean Sea. And so those are the alternative routes. If you combine all these together, from the research that I've seen, you've got a total theoretical capacity of approximately 10 million barrels per day that can route around the closure of the Strait of Hormuz. You could imagine that the real capacity, some experts say, is about 5 to 6 million barrels per day. And so, due to the port limitations and the infrastructure wasn't really at full capacity, particularly in those Iraq routes and those Iran routes, this is the reason why you may not be able to get that pumping at full capacity. But the market implication was effectively that the Strait of Hormuz, prior to its closure, which was closed via an act of parliament, the IRGC said they will enforce it. Then there was the insurance premiums that effectively closed the Strait of Hormuz. And to this day, there's still not been any oil tankers or enforcements of that, other than interceptors that were taken down, and then the shrapnel hit some of those naval fleets. So we haven't actually seen a full-blown naval war. So in effect, it was the financial industrial complex in reaction to the announcement that actually led to the Strait of Hormuz. We'll go through a little bit of the detail. But prior to that, there were approximately 20 million barrels per day that were going through. So based upon some of this bypasses of if you can get 6 to 7 million of the 20 million, then they've been able to bypass some of the shock factor, but it doesn't resolve it. This is a temporary solution, and it can't be fixed short term by fixing infrastructure. These are longer term things. However, it really explains why oil is kind of went back down to around this $90 range. and also has a peak of about $150. So the next escalation risk, as we've already hinted at after this, is what happens in the Red Sea. And so if the Houthis are activated, then that is the next phase of the escalation cycle. If you stop and close the Red Sea as well as the Strait of Hormuz, we know that the closure of the Strait of Hormuz brings us to a peak oil where there's mass intervention of $115. And the tools that you can use are depleting because the taco trade is becoming less effective. And so then you're really only left with depleting strategic reserves, which creates risk for the countries that are getting through their strategic reserves. And what is the time frame that that puts on it? Or you've got the opening up of sanctions, firstly on Russia, and then the only one left, which is the negotiation, the opening up of sanctions on Iran. And that really is the crux of the matter of this, what the end result is. Now, the market's saying, because the markets aren't crashing, because gold is flat, because oil's up, because it's being contained, because Bitcoin's up throughout this cycle, that's really, which is, more correlated to the AI trade at the moment. The market's saying that they know that there will be a defined end. And I personally believe the theatrical element of this is that while you have those trying to derail the plan, those that are in charge have already defined the parameters of this and are profiteering from this as well. So anyway, whether we get the opening up of the Red Sea, the closure of the Red Sea, and those Red Sea exports, that would be the next phase of the escalation cycle in order to pressure this towards a negotiation. And that would effectively, you would have to use mass intervention. The futures market positions may lead to some losses that may need to be bailed out. But basically, the ships must pass. If they don't pass, then this is effectively the full closure, and we haven't seen that factored into the market yet. And so the Houthis and whether Iran activates those really is the next phase. It's interesting that it hasn't so far. Now, whether that's an escalation ladder or whether it's going to bypass that escalation ladder, we're going to see whether this happens or not. But effectively, the Strait of Hormuz plus the Red Sea being closed means millions and millions of barrels of oil are removed from the market. And that is really the next escalation ladder based upon everything we've seen so far. So the current scenario is again $110 where we get intervention. And this is based upon being able to circumvent some of these choke points, but not to the full degree. And right now, the strait is not physically destroyed. There's been talks about mines and various other things. That would be counterintuitive. That seems like propaganda. But there's been no confirmed direct tanker strike, as far as we can tell, in the fog of information. There's been accusations, there's been propaganda, but as far as we can tell, those have all been debunked. Now, what is interesting is that the planes, now remember, this is all being fought between Iran, Israel, and then the US bases across the country, across the region. Those are all being fought with missiles and drones in the air. And yet, while we had 20,000 planes cancelled, which impacted the tourism industry, the insurers didn't stop the insurance of the planes. And so planes are still moving and planes are still insured. So why did the insurance industry decide not to insure the passage of shipments in the Strait of Hormuz, but they did insure the planes, despite the risk being similar? And why did Trump not talk about impacting, going at it with the insurers? To me, that implies that the financial industrial complex is strategically having their impact, and they know the defined outcome, and they're also confident in those futures oil positions. because they have an idea on the timescale and time frame of this, and we'll keep watching the market as well. But most of the damage that's happened right now has just been debris from interceptors as well, and some of those missile fragments, but nothing else. And yet, shipping is completely blocked up. This is going to take months, even if it gets open today. And the impact has already been had. There's no changing the impact of what's already happened. Now, there is a negotiation cycle for those that are able to get the safe passage of oil NG to use this moment in order to lock in longer term agreements and take advantage of the crisis. And that is being done right now. And I see when I look at it, and we'll cover it a little bit more, in line with the exact predictions that I've been making around a multipolar world. And so the war risk insurers can really change that, whether they withdraw coverage or whether they continue coverage as well. And then it's about the enforceability that we'll be seeing. Okay. Premiums have exploded to the point where you can't put those passage through. It was like 75% of the entire cargo value. And without insurance, you definitely can't get any of these ships through. It just can't happen because it's too much for a business to actually factor in. So anyway, the Strait of Hormuz was effectively closed by the financial industrial complex, either reacting to the announcement, but they didn't do that for the planes. And so, how do we interpret that? Is that a part of the coordinated theatrical understanding of markets? Or is that just normal reactions to something that's unprecedented? I'll leave you to decide. But Qatar Airways started to open it up. Emirates Airways, they started operating. Obviously, less people are using those, but they're still able to get the insurance as well. And so, that's what's really closing these strategic choke points. And to me, I think it is buying the time to negotiate some of these alternative second and third effect energy contracts, and also drain the strategic petroleum reserves of the countries, of the GC7 countries. They haven't actually released any yet, to my knowledge, in week two. They've said that they deployed that they were, but just the announcement of doing it is enough to actually create a reaction in the market as well. But if they don't actually do it, again, you get a taco effect on the G7 countries as well. Now, what did they announce? They announced that they're going to be releasing 400 million barrels and they're going to get that ready. Now, let's take a look. What is the impact of 400 million barrels? So the world demand for oil right now is currently 100 million barrels per day. So effectively, if they release 400 million barrels and there's not any of these alternative routes, which of course there are, if you just take the G7 stuff, this is basically only 3 days, 2.7 days of demand, relative to the actual impact it can actually have. So if you look at the August Hormuz disruption, if you get those alternative routes, then effectively that buys weeks. It doesn't buy months. So the strait cannot be closed for months without draining all of those allocated strategic petroleum reserves. And the majority of that is coming from America, which was only half at the rate of what prior to this of what they wanted it to be anyway. And you can't use the oil in Venezuela, and so it's not really fixed by that as well. So it can provide a little bit of a bridge, but it's definitely not a solution if this were to be a long-term war. What about supply chains? They're all affected as well. So it's not just oil and it's not just liquefied natural gas and LNG for electricity. The key industries that are also affected Obviously, we've got energy and oil and LNG, but what about chemicals and petrochemicals, which has an impact and a knock-on effect on pharmaceuticals? It also is the different types of food, fertilizers. This was actually a strategic point for India. It relies upon those fertilizers, also lost its gas, which means that that impacts Indian internal politics because they were trying, there was a, remember those farmers' revolts where effectively India was importing agriculture from America. During the trade negotiation, that went down. Now it needs to probably import those agricultural products, but that impacts the internal farmers. So who is going to be exporting those agricultural products? That's mainly America, as well as the LNG that America will be exporting likely towards Europe because they've only got a couple of choices. When Qatar can't do it, you've only got America and Russia. And obviously, Russia can use that leverage, and America will also use that leverage as well. And so that's why Europe has been the most impacted, and it's been the biggest disaster for America. There's also sulfur and sulfuric acid, which has a disruption in the supply chain, various mining components, and the second and third knock-on effects. Copper, cobalt, as an alternative to silver. Remember, with the price of silver, the big squeeze, we haven't seen the impact of who was on the wrong side of that trade. We saw the Fed switch from QT to QE on the short-term treasury. We saw distress in the repo markets. And then we saw a massive increase in the price of silver and then a correction back down, a massive volatility. People were looking at, China shut off some of those supply chains, saying that you had to get government permission for the companies in China to export and some of those refining processes. And an alternative was copper. It can't, produce electricity at at the same rate that silver can in terms of efficiency, but copper was looked at as an alternative. So all of these commodities are impacted, as well as cobalt, and the food, the insecurity that we talked about as well. Um, Also, yeah, some of those components inside technology, which impact South Korea. And so that was why there was a big impact in the stock market as well. And that has its impact on semiconductor chips, which is AI. You've got the key strategic points. Taiwan needs oil. They need to produce semiconductor chips. Europe, Netherlands needs, they're reliant upon either the North Sea, which prior to this, the UK, which I don't think is a coincidence, implemented windfall taxes, which had a massive impact on the capacity of the North Sea oil. That made them dependent upon Norway, Russia, Qatar, America. Now those options are being severely reduced as a result of that tax policy as well. So in the AI chain, you've got China, you've got Taiwan, you've got Netherlands, you've got South Korea, and then you've got the American infrastructure. That is, if there's any disruption in that, severe economic consequences as well in the long term. If this carries on for 2 months at this rate, we would be in a ginormous global financial crisis, and we've already seen to start some of the stress points in the market. But industrial metals are also impacted, and there are other sectors that I haven't thought about, but those are the main ones as well. And we'll start to see that. Obviously, we've had impacts in aviation. Jet fuel is at its all-time high at the moment as well. So that has impact as well. And then knock-on effects in terms of tourism. There's been a big drop in tourism to the Gulf countries. That affects, not only shipping and tourism in the Gulf, but also aviation impact as well. The tourism, mainly the biggest impact, of course, would be in Dubai. There has been targeting at both the US military bases and also alleged infrastructure, either via false flag or via Iranian targets, into the airport. And then those interceptors have had disruptions where shrapnel would fall onto hotels like the Burj Al Arab, And then obviously tourists are going to just say, well, we'll sit this one out until we know what actually happens. Then you have Doha, Qatar, Abu Dhabi in UAE, Saudi as well, Riyadh, and flights are still operating, but the participation is down as a result of this shock in terms of the industry as well. So Gulf effectively take a hit in that sense. Plus, they got the reduction in LNG and oil sales because they're using the alternative routes at capacity. But the price of oil and price of LNG is going through the roof as well. So what they are selling is at a bigger impact. And as we've covered as well, if those US bases are being targeted, they get to demonstrate that the US was effectively occupying their region, not providing protection, using that in order to provide intelligence to Israel for some of those operations that helped the US military industrial complex agitate the region. If those are gone and destroyed, they get to be renegotiated. The optics is perfect. The people will ask about it. And we've already started to see renegotiations between UAE, South Korea. We've already started to see impacts in terms of renegotiations with China and Russia. And really, it helps make that managed transition where effectively the US has a much smaller footprint in the industry in the Middle East, which is in line with that multipolar world and the Middle East going eastwards and becoming West Asia as well. Um, so anyway, they can try and make up for some of it, but have no doubt this short term is very disruptive. And also, they reacted by pulling back some of their AI and defense investments in America. And if you look at the AI trade and the investment in data centers, America would have very low growth last year if it wasn't for that. That relies on both the private credit markets, as well as a functioning stock market, as well as the Gulf sovereign wealth funds as well. So, um, right. The big impact, as we covered last week as well, is European energy. They're incredibly vulnerable, and some of the Asian countries are incredibly vulnerable. Taiwan, Japan, South Korea, Bangladesh, some of the Middle Eastern countries like Jordan, Egypt, where their LNG supplies have been cut off by Israel. You have Europe, which is incredibly dependent, India as well. So these countries need to renegotiate terms. Now, after the Russia UK anti war rhetoric, how easy is it going to be for Europe to renegotiate some of those LNG supplies? Well, they were buying, LNG from Russia throughout this whole war while effectively saying that they were sanctioned. But Europe effectively pivoted as much as it could from Russian gas to Qatari gas and liquefied natural gas imports from both America and Qatar. And so when Qatar then cuts its production, you've only got US left and Russia left. And then obviously anything you can get via some of these Norwegian oil exports as well. And so the Hormuz closure impacts Europe greater than anyone else. And so this is the most likely sign that either America or Russia will use it for leverage in terms of its negotiation over Ukraine, and America will provide a counter to that. And they'll try probably say, well, if you don't want to go to Russia, you're going to need to lock in some long-term contracts for us. And Trump will say, yes, we're here to provide energy security for our friends in Europe, of course. That would be on incredibly predatory terms, as you would expect. And so the result of that is basically, you get energy diplomacy, and that has an impact on the Russian side and the American side as well. And who is the victor of all of this? Without a doubt, even in the Western Hemisphere, that side of the multipolar world, Russia is the victor. Now, US, while it's taken advantage of for its private sector interest, remember the US is controlled and owned by the financial industrial complex, military industrial complex, and technical industrial complex. Financial industrial complex sit on tops, and oil and energy routes are a part of that infrastructure. So the US can effectively negotiate contracts to make transnational capital more powerful. The US becomes more subordinate, and Europe becomes more subordinate to US private sector interest. That completes the project of vassalizing the Western Hemisphere into full command and control by the financial industrial complex if it wasn't enough already. Now, that also sets the border between the multipolar world, which Russia can set, because what's Russia doing? Russia immediately went out to help its neighbors across the entire world, including Asia. Now, imagine if you're Russia and you were the most heavily sanctioned country in the world, as was Iran, and immediately you get some sanctions relief in order to contain the crisis, which shows the extreme measures that the US is willing to go to in order to contain that price. Then you've gone from selling at a discount at $35 or so, whatever it may be at the lowest, maybe it was $40 or more at the discount, we don't know, to approximately $100. That is a ginormous boost to the Russian economy, to its strategic reserves, and it is de-dollarized. So none of that is going to go into US treasuries. That's all going to go likely into, because they've already got their energy, they've already got their reserves, they already can print their own currency. So where are they going to put that? They're going to put that into gold, and they're going to put that into commodities, and they're going to put that into fellow investments into the purchasing imports from China. So that draws Russia and China closer. It creates dependency on Russia to the Asian counterparts, and it supports the Russian economy to really set that BRICS corridor. Now, while the GCC are working at lower capacity, and the GCC wants to negotiate the alternative to their US bases, Russia can use that card in order to remove the GCC countries from the US security agreements. The GCC are then holding back on their investments in AI infrastructure, which is what's propping up the growth in America and the US markets, while they're making up for that by doing LNG sales, but that's for the private sector. So you imagine that to manifest in the stock market, which is what's preventing a major market crash because defense contractors are cashing in as well as the oil and energy, whereas everyone else suffers. But it will start to have bigger and bigger impact if the price of oil keeps going up. And it's really, at the moment, at the time of this recording, it's been about those $100. So that gives higher revenues to those private corporate interests in America and Russian national interest as well. So $100, they don't mind if this goes on for as long as possible from the Russian perspective, because they don't have any knock-on effects. This is just pure win for Russia. America, it has impacts on their financial markets, which is why they go into Russia in order to get the oil price down. This gives Russia all the negotiation chips as well. So US effectively announced that they're on a limited and minimal time frame. Scott Bessent announced that they're going to remove some of the Russian sanctions around oil that was in the sea. There was record levels of oil on sea leading up to this, which is why China, Russia, and various other forces, a lot of people knew about it as well, because we had record numbers of oil on sea. China had been building up record reserves in order to ride this one out. And Russian oil shipments effectively have already started moving, and they're already starting to ease the pressure. That's what really dropped the price from that 115,000. You had the taco announcements from Trump, you had the G7 announcements, but what really moved, what really made a difference, everything else is theoretical, was actually those Russian shipments moving and the sanction relief. So Russia's cashing in and Russia's controlling the price at the moment. And this was effectively as a result of Russian, barrels being able to stabilize the market and their already existing infrastructure that was only stifled by sanctions, which is why NATO escalated the war with Ukraine, and why the CIA blew up Nord Stream pipeline. And why we had all these secondary effects where BlackRock was doing ESG policy, leading to the destruction of the manufacturing base in Germany, leading to the shutting off of nuclear energy, leading to the dependency and the destruction of Europe and the debt crisis that it's going through right now, all leading up to this. Um, so anyway, we've already seen that Europe has already bought more LNG from Europe while engaging in those negotiations. This is massive leverage, and it also shows you the theatrical element of everything. Just take a step back for a second. America cannot construct a drone, a missile, an F-35 fighter jet, anything while they're being massively depleted right now in terms of their supplies with all of these wars. But they can't produce anything without China. If China stopped exports tomorrow, the US military industrial complex can't replenish their supplies. Uh, America imports highly enriched uranium for their nuclear program, part of it from Russia. Europe imports its LNG from Russia. Think about that for a second. That's how you know the theatrical element of this and the proof of weapons network is managing these big events in order to reset the world order right now. Because if this was World War III, if any of these escalated to genuine, non-agreed negotiations where world leaders had agreed on the outcomes that they're pushing towards, with obviously elements of disruption along the way from previous powers, then that would be a real war. That would be an embargo, which during World War II, you had Pearl Harbor, you had the oil embargo, and then you had the atomic bomb blowing up. That's a real war. That's what it looks like in reality. What we're seeing right now, I believe, is still agreed negotiated outcomes based upon the power dynamics that I'll be covering in part two. And I'll go through all those different powers. And the clown of thinking it's just Iran, US, Israel in a war, when you have to understand the factions of power within each of America, Israel, and Iran, and obviously BRICS and also GCC to understand what the real war is. We'll be covering that in part two with the interview anyway. So anyway, the energy map is splitting the world up into multipolarity. This is the global reset. This is the execution of the outcome. It started with tariffs when Trump was installed because China had won the trade war, and Trump created Dollar Liberation Day to reset all of the negotiations. And then ever since then, we've had the different theatrical phases going into the effectively October the 7th lies around what that operation was. The failure of the complete ethnic cleansing and genocide because Egypt didn't allow for the border to open and didn't take the IMF bribe. Then that led into the regime change from the Biden administration to the Trump administration. Then we had the Houthis that executed the ceasefire agreement. Then we had the 12-day war, which was the narrative for Trump to say, here's a Hollywood movie, how we took out the nuclear program. Israel to go back after they depleted all of their defense and the Iron Dome. And Iran effectively took out key strategic points. For Israel to say we took out the head of the snake. And then, of course, on the Iran side, to do not a regime change, but take out a bunch of IRGC hardliners that weren't on board with China's plan for regional stability, and then we entered into this phase, which is the closure of the Strait of Hormuz, the taking out, the attempted regime change, which failed because it wasn't met with military coup. Revolutionaries only match when they can take over the army. So then you had that theatrical element that led to the military buildup. And then you had the strikes from America, effectively raging an illegal war and invasion on Iran. That then led to the destruction of the US bases in the Gulf countries, and also more taking out of hardliners in Iran, while there was a simultaneous negotiation, and everybody that was at the negotiation table within Iran is alive today. Whether that be IRGC members, in whether that be the reformist, pragmatic government members, and we'll go through those. And then it takes us to where we are right now, the Strait of Hormuz close. Then you get the renegotiation in line with a multipolar world. You get the oil price that is being contained in order to strategically manage those transitions, reset the world order. And we know that this can't go on long term because it breaks everything, which is why gold has held as if this isn't World War III. Oil has gone up, and markets have only corrected to a small degree in the US, but a bigger degree in the other countries that the renegotiations are happening with. And so Europe is effectively now a US LNG dependent, depending on sanctions relief on the Russian side, which builds the Western Hemisphere. And Asia, for now, while the Strait of Hormuz is closed, is a Russian oil and gas dependency, and they need full dependency on Chinese exports. So really, that GCC BRICS corridor means that effectively the Middle East, which was a term that was created by British colonizers and French colonizers, because they were looking east and considered it the middle. But prior to that, it was a part of Asia and it was called West Asia. And you had the Ottoman Empire that led to Sykes-Picot, the breaking up of the Middle East, the installation of, British and French, oil exploitation and leadership and monarchy structures. And then we've had the rise of China that has made some of those changes. They had the forever war model, where the US effectively made sure the Middle East was always at war. And then you would have, the installation of the Soviet Union by the same people that installed the Federal Reserve, by the same people that transferred gold from the Bank for International Settlements to the fascist Nazi regime in Germany, funding all sides of that so that you could get Russia's war, transfer all the gold over to Fort Knox, and then do Balfour Declaration in order to create the Zionist entity that became a division for the US military industrial complex post World War II in order to continually agitate war, so that you could enforce, that you could get that war, create the petrodollar. Whenever there was a war to attack the petrodollar, it led to assassinations in Saudi Arabia after the oil embargo. And then you entered into the fiat currency standard when effectively US defaulted on its debt by removing the convertibility into gold and removing the ability for European and American bonds to be repaid to Russia when they sanctioned the money in the 2022, and the de-dollarization knock-on effect that's happened ever since. All of that has led to this new world order where America is trying to show strength while it shrinks. And Russia emerges as the economic winner as a result of week two of the Iran war. So what comes next? What did the financial markets actually do? So basically, what the stress appears to show us, just as a recap as well, is that the energy shock has basically split into various different factions in finance. The key issues is that we saw at the same time stress in the private credit market. Now, this could be coincidence because I don't think they're impacted. But let's work through what is the private credit market. The private credit market was previously a way for institutional investors to provide business capital, business lending, receive higher yields, like 10% returns, as a result of banks really focusing on real estate, mortgage-backed securities, and retail credit cards and mortgages and loans. But that they didn't want to lend to business, so private credit kind of took that market where high net worth investors would invest in funds with fund managers in order to invest in private credit. Now, when you're lending to a business or investing in private equity, that's a long-term time frame. It can be like up to 10 years for private equity, but it can be on set terms for whatever the business goal is um, for for private credit. Now, if that's being invested in AI data centers, many of these AI data centers, they don't have a revenue model right now. So it's like debt that is long-term capital that isn't going to produce a return because this is a longer-term capex infrastructure play. And so the private credit markets decided to do a couple of things. Firstly, they opened up to retail. Now, retail don't have the level of sophistication normally to understand what they're investing in because they're not professional full-time investors. They just see that they could get out of it within 3 months if they wanted to, but there were terms that led to force majeure. Force majeure is when there is exceptional circumstances you can default on the contract. And one of these is exceptional circumstance that they're saying a breakout of a war has led to force majeure. And so now those retail investors can't get their money out in the next 3 months. So what are the private credit investors doing? Well, they're trying to facilitate those withdrawals. So they called force majeure, they suspended the withdrawals, and now they're trying to sell those assets in distress to probably the vulture capital and private equity industry. And they could end up flipping those, or they could dump them on pensions because part of the policy of the Trump administration was to open up 401ks to private credit, private equity, more exotic products, and also crypto as well. And so there may be an environment of dumping those on pensions, but the stress is starting to be felt. And so at the extremes, some of these private credit products are selling at 14 cents on the dollar to try and get some liquidity. That's the price at which the market and sophisticated investors are willing to pay to unblock some of these withdrawal demands. So it doesn't have an impact on who is underneath all this, which is the mortgage-backed security markets, the 10-year treasuries, the bank loans that are behind a portion of this. So effectively, is backstopped by the bank because all of these institutions, private equity firms that are providing the capital up, they've been borrowing through leveraged buyouts and various other things. So the market is leveraged, it's just very hard to see it as a result. And so, as I said, now, what was a bunch of this? This was the AI trade and the data center trade. A bunch of the companies that they were invested in are being disrupted by AI. Software as a service companies that had that cash flow that can help you receive dividends, that can meet your demand for withdrawals in some of these private credit funds, they're going belly up. They're the ones that are impacted by AI disruption. So the value of those assets are going down, leading to more and more mark-to-market write-downs, which was the issue that happened with the mortgage-backed securities. And you're looking at the insurance market via credit default swaps. You're starting to see some of these insurance premiums as well show significant signs of distress. And so the US recent growth market was as a result of these private lending markets. It was non-bank credit that was driving a bunch of the growth. It was capital funding through private equity that was driving a bunch of these growths, leading to pre-IPOs and a bunch of the AI companies that are set to go public this year, like OpenAI and ChatGPT, Anthropic, and others. And that needed the build out of the AI data centers. So the infrastructure play is now suffering stress because now the Gulf countries use that leverage to say we'll renegotiate our terms on many of those investments. Remember Trump? He's always bragging $18 trillion of inbound investment. We've got the hottest economy in the world. Well, that's foreign direct investment and private credit markets domestically, as well as some of the corporate venture plays that's putting up some of that investment. And so the Gulf sovereign wealth funds have now got a negotiation chip as well. They can pull out of their purchases of equity unless this comes to a fast halt. And remember, the sovereign wealth funds have been effectively using their negotiation to co-op BlackRock, State Street, and Vanguard and join the financial industrial complex so that they can place influence over the military industrial complex, which is why I believe this is still a transitional war. So during week two, what did we have? We had major institutions that were restricting their withdrawals. We're talking creme de la creme. We're talking BlackRock. We're talking JP Morgan. We're talking Deutsche Bank. And so that started to look like optically another crisis that creates fear. What do the retail investors do? They say, give me my money back no matter what. They try to get it out at any price. The institutional investors start trying to sell off at a discount. They start to write down the value of these assets. And what can they do? This was stress that already existed prior to the market. So now they can use this opportunity to write down and basically write down those losses and blame it on force majeure and other impacts. And so I think they're cashing in on that opportunity. And so the media is creating a bit of a frenzy around these withdrawals that looks a bit like a bank run at the moment. And so again, they can effectively, the crashes create the optics of a financial crisis. It looks like a bank run. And remember what we covered earlier around Silicon Valley Bank. Now, what is being impacted? What market? Well, the bondholders are saying, I want higher yields in order to lend to the US government. So we started to see since the war started, while the dollar's been strengthening, the yields on those long-term treasuries, 10-year, 20-year, and 30-year bonds have been steady rising. This increases the interest on the debt. It creates more financial pressure. And the higher the dollar goes in terms of strengthening, that reverses the trade of weakening the dollar in order to create fiscal dominance, roll over the debt. Now it's got to be rolled over at higher rates to prop up the stock market so that you can effectively do fiscal dominance and devalue the dollar through inflation. Now you've got inflation plus supply chains plus oil. So Trump's obviously going around like a headless chicken saying, don't worry, this is temporary, it's worth it, and we'll get prices down. Now, the second the Strait of Hormuz opens, oil's going to crash probably below rates that we've seen before. But they know, somebody knows the timing on that. And that's because I believe the financial industrial complex is aligned with the Gulf sovereign wealth funds, who's aligned with China, and China's exerting influence in terms of the reformist factions and also the IRGC elements that were sat around the negotiation table, while Israel and America take out some of the hardliners and you create a Operation Ajax 2.0 to make the monarchists think that you're going to actually have a regime change. You won't have a regime change, but you create the optics of replacing Khamenei with Khomeini, which gives the optics for the off-ramps that may be potentially happening, and what I believe we are leading to as well. So all at the same time, you have what looks like a US debt crisis encroached. You have the 10-year treasuries, the cost of the debt going up, the 20 years and the 30 years, and gold isn't really going through a spike. And so this is basically meaning that the cost of refinancing the debt applies vassal pressure on US by bondholders. And it also implies vassal pressure on US by the private credit financial industrial complex. It also implies vassal pressure on US by the Gulf sovereign wealth funds. This is why I believe that the US military industrial complex is effectively a for rent militia for the financial industrial complex, the FIC, at this stage. We'll be covering more about that in part two. And we got the narrative framing that essentially we have financial instability by the price of oil, as well as an inflationary spike and everything that can happen as a result of force majeure and not opening the Strait of Hormuz. Now, that can lead to, if this goes wrong, a real oil short squeeze, where some of those contracts push the price up of oil, push the price of oil up significantly, and that can break a lot of things. And that was just like we saw in silver, and we still don't know who's on the wrong side of that trade. So the only thing this ends with eventually is the Strait opening, a deal which has significant concessions, a three-way victory, and also in the US, a big print. This will be a ginormous print in order to devalue devalue the debt, return to the weakening of the dollar, return to the capital outflows, and return to the multipolar trajectory of dollar weakening and turning America into a regional power. But this has accelerated it significantly. So this really is, I believe, in my estimation, the hidden financial reset is driven by financial industrial complex and that faction that we'll cover in part two. And there is a ginormous opportunity for those that want to capitalize upon the crisis. And that tends to be with those aligned with the finance houses and those that control and can move their energy, which to a degree is US, but mainly Russia at the moment. And the private credit exposure gets to do their write downs. Some loans become unprofitable. You can blame it on force majeure. And then you can get back to data credit financing with negotiation leverage with the sovereign wealth funds at the moment, as well as the private credit markets. um, um, okay. So that's what I think we're seeing by following the market right now. Now, what was the other thing? Right. I wanted to discuss some potential predictions on timing in terms of off-ramps exit. If this was a real war, the markets would be reacting differently, as I said, if there weren't key players in the FIC that know the outcome here, and the timing of the outcome. This can't lead to an all-out victory by Iran, despite the fact that they're actually embarrassing Iran, Israel, and America right now in terms of their asymmetric warfare with their superior technology with drones, ballistic missiles. But they're being very strategic about it, and the press and Trump is giving you a clown story around what's actually happening here. But the timing of this becomes something that I've been predicting long term. I originally thought it would be a 12-day theater, but it looks like they're doing major, major escalation. Now, remember, I covered that, what a theater actually means. It doesn't mean the bombs aren't real. It doesn't mean the casualties aren't real. It means this is a managed transition with global powers agreeing on the outcome and then alternative powers trying to disrupt the plan. I'll cover that more in part two in deep detail. So what's the timing? Well, in April, we have the China summit. At the China summit, this is effectively when Xi Jinping is going to be meeting with Trump. And I think this will be the end of the managed transition. This is where you get the agreed outcome of the trade war, which had already been won, which had already led to Liberation Day as the execution of the managed transition and the theatrics we've seen ever since. But all of this is unfolding right before that. And so I'm expecting Xi Jinping and Trump to have that meeting in China. I don't see a set of circumstances where Iran has a victory and that leads to the expulsion of Israel. I don't see a scenario where Israel and America destroy Iran and get a regime change. I don't see a scenario where this is a long-term war, like either the disruption of Syria or trying to create a government like Iraq, or a military industrial complex forever war profit model like Afghanistan. Don't see any of those as likely outcomes. And so, really, the only thing that can come from this is concessions and a deal, which I think was already negotiated. And this war was part of the negotiations as well. So, what is the feasible, themes that we can actually get here? What's the summary? This is the managed transition to a multipolar world order. It's been done accelerated faster than I predicted. And this is going to resolve all the issues as well at the same time. Is resetting the energy flows. We've got the global financial reset that can happen from any impact on the US markets. But the gold signal is saying that this isn't going to escalate to World War III. So what we have seen so far, oil up, gold up and flat to a degree. But you know, what should really happen in World War III? There should be a ginormous flight to gold, and there would be, moving up to $6,000 gold, $7,000 gold, $8,000 gold, up to even $10,000 gold as this progresses. We should have oil prices above $150 if there weren't those interventions. But instead, we're getting oil up, gold flat, and Bitcoin up, which is a high beta play on the AI trade at the moment, because people haven't realized that it's a self-custody trade until you get mass force majeure, and things like that. So the meaning you can say is that the market right now is pricing just for an energy shock, but not a systemic collapse of the private credit markets or a systemic collapse of any of the markets as a result of World War III. So the markets expect an off ramp. And I believe that already there may be a bit more to be achieved. But if you look at it objectively and sit back, I think many of the strategic objectives have already been achieved in this. What is the strategic objectives in those factions of power that might be negotiating? Well, each actor has basically achieved something that they can go back that doesn't cause civil unrest, gives a narrative that is needed, just like we had in the 12-day war, but effectively resets all the things that I said are trying to reset. So what does the US get out of this? Well, they get effectively the narrative that they degraded the nuclear program, they decapitated all the infrastructure optics, they basically weakened Iranian air defenses. They'll just declare victory despite what the reality is. Those things have been weakened, there's no doubt about it. But they'll just declare it anyway, and Iran could continue this because much of that infrastructure is deep buried in the mountains as well. So you get all of that narrative, but also Trump gets to say we were strong, we didn't create a ginormous war. And I think he'll want a Hollywood movie like last time where he gets to kind of show and have a public demonstration that he can take back to MAGA. And he can say, we achieved it, we crushed it, Iran capitulated, and guess what? We got a deal done. Israel basically needs to go back and say that they annihilated and decapitated the Iranian proxy networks, and now our borders are secure. So they can say our borders are secure in Lebanon by what is happening with Hezbollah at the moment. The government is meant to be engaging in de-weaponization as a result of that. You can say the borders are controlled in Syria. They could say they overthrow the Assad regime. We protected our borders in Syria. And we've already started to see that there is a GCC puppet, ex-ISIS, in charge. That's pushing Turkey's interest. And there's a placeholder government to achieve regional stability. So you get the exit off ramps. Basically, all the lies that Israel said when they were a disruptor for the military industrial complex, they can say that they achieved their goals. They get to say we took out Hamas in Gaza, We've now got the 20-point plan by the Trump administration. The Gulf countries can fund that plan contingent upon additional concessions around who owns it, what the routes look like, US exit from the region, Palestinian statehood. Iran can pull their leverage points as well. And effectively, China normalized between Iran and the Gulf countries and Saudi in order to achieve a resolution to the Palestinian cause and a US exit from the region. All of that can be achieved if we have an off-ramp narrative. I believe in Israel, you have an internal power transition. We're starting to see questions around Netanyahu, his family, Ben Gvir, Smotrich, the ones that are more radicalized extremists. In America, we start to see Tucker Carlson, Candace Owen, all these different types of people stamp out the radical neocon Zionists and expose it for what it is. Lindsey Graham is looking like a cartoon character. Ted Cruz is looking like a cartoon character. All of these old neocon dinosaur fossil fuels that say we must stand by Israel. We had the Mike Huckabee interview. We saw the Christians exposing how Israel treats the Christians, how they spit on them, all that stuff. So all of this points towards a regime change within Israel that will be leftist aligned, that will be a GCC Turkey puppet, that will have to normalize based upon China's plan with, the plan that China set forth between the Gulf countries and Iran with the financial industrial complex. Iran gets to do a political shift while maintaining the optics of we prevented a regime change. Now, you can see some of the elements that happened in week 2. One of those was on March the 7th, Pezeshkian, which is the I forget whether it's president or prime minister, effectively the reformist government in Iran that needs to get sign off from the IRGC and those elements. He gave a speech, and in that speech, you've got to be careful with how the words. It implied that the Iranian government, and he can signal to Trump and and other powers that the civilian control has been achieved by the government over some of the military assets. That's what the speech and the statement implied. That was on March the 7th. The IRGC basically is showing that the symbolism was that it was announcing that the fire at will elements of the IRGC are no longer here and they have been revoked. And so that signals to the financial industrial complex, to the other factions of power, that there is, a internal change that's happening that can lead to this negotiated outcome. We also saw on March the 8th that the son of Khamenei, the new Khamenei, basically was agreed and installed as the supreme leader. Now, if he gets assassinated, then maybe that implies that he wouldn't have been on board with the plan. If he doesn't get assassinated, then prior to this, I didn't think, if you remember in my predictions, that Khamenei would be taken out. But if Khamenei was already cooperating the father in terms of, this new element, because remember, there was internal change that happened in Iran. There was the helicopter assassination, and there were the arrests that happened with IRG hardliners under the previous leader. Maybe his son is continuing that work. And that work was to get to the outcome that we're witnessing right now. And so we could end up with, some kind of the hardliners signaling that they're ready to move to a negotiation. And this would prove the legitimacy of maintaining the IRGC structure. And you have somebody that has to be listened to, which is Khamenei. And so if he agrees the victory was achieved, we did this to Israel, we took out the US bases, and we have a plan for the Palestinian cause, then he can maintain legitimacy with the IRGC. But it would be an IRGC. Everyone that wouldn't have gone along with the plan has already been decapitated. And we've already seen a parallel like this in the past. If you remember, Khamenei, when he ended the Iran-Iraq war, there was a similar thing. The IRGC got to maintain, that type of narrative. IRGC had to listen to the Grand Supreme Leader, and then you had the government underneath as well. So we may be getting a similar things, and that to me still can be the only outcome as a result of this. So the IRGC effectively remains. So this prevents a collapse. This prevents Iran becoming an economic disaster. Only the military industrial complex, the neocons, and the radical Zionists in Israel want that. The financial industrial complex, China, the Gulf countries, and the other factions of power, they don't want that. And so this is likely to be, I believe, on everything we have seen, the final act. I couldn't predict all the details. It happened differently to I imagined it would happen. But I think the end goal and the destination is still completely intact, and the market is telling me that this is heading in the direction that I thought it would head. So there might be one more major event likely. Maybe we get another spike in oil. Maybe we get someone derail it, and so it goes on a little bit longer. But I think the end of this is you need a US strike on a nuclear facility similar to Operation Midnight Hammer that makes the market panic. The sophisticated investors still won't, spike the price of gold. If gold and oil start managing in unison and you get an assassination of the son Khamenei, then this is going on a different path. This is going on a neocon path, and maybe there's more operations to get to the end thing. The FIC will still win, I believe, in the end. But the US strike needs to happen in the nuclear facility. It needs to be like Operation Midnight Hammer. It needs to be dramatical. It needs to be a Hollywood movie. And the purpose of it is to Trump to declare victory once China has done all the work and said, we're moving towards regional stability. Trump gets the credit. Trump needs the visual victory moment. And we need a narrative that effectively said, Trump, we destroyed Iran's nuclear program. And then you have the optics that are needed. And I think that will be effectively the final act of the operation. And then we'll move towards a deal. I'll be covering what happens in week 3. Let me know in the comments section whether you think I'm completely wrong, whether you think I'm right, whether you think that following the money has been a useful thing, whether you think markets are getting things wrong or things right. Let me know in the comments section. I will read them all. I'm predicting that there is going to be a ceasefire in March, and the market is pricing basically that there will be emergence from this, and maybe another oil spike is possible. But I think those futures contracts that have been suppressing the market are not going to end up in a short squeeze force majeure. I think they know that the price of oil at the end of this is going to crash like crazy, and they know how long it's going to take, and they would have set those derivative contracts accordingly. But I think it's unlikely to go above the $115 ceiling, and if it does, I will review this. But all the tools are ready in order to do that. The Strategic Petroleum Reserve release, maybe there's a plan to drain all of the G7 of their strategic petroleum reserves into this. OPEC supply and Russia, particularly leading OPEC and OPEC plus. This is not long term. This is not going to be Iraq. The Russian sanctions is the other tool that they've got. That could be massive relief, and it could open up into another front. But I don't think it will, because I think the military-industrial complex have negotiated that we want the Ukraine-Iran war to continue, and Trump's not allowed to deliver anything there. But the border peace will be doing the negotiations between the military-industrial complex and the financial-industrial complex as they effectively manage in this multipolar world order. And this will be followed by Iranian sanctions relief in the end. And in summary, what happened in week 2 Week one was effectively the shock and awe and the damage, and it's saying that we are in a war, and everyone to think that this is going to go on forever. Trump's made a critical mistake, all that type of stuff. The end result, as I said before this, before it even started, that the end result is a weaker Israel financially and in terms of strategic points, ready for acquisition, likely by Indian relationship and UAE relationship of key strategic privatized assets, ready for regime change into a leftist government, and Netanyahu getting his victory, or Netanyahu getting his peaceful exit based upon the leverage that he used. Is going to have a weaker Iran, but the economic opportunity is going to be significantly stronger as a result of the China plan. And that is going to be probably Russian guarantees on enriched uranium, Chinese security guarantees, maybe Turkey and Egypt and Pakistan involved in some of those agreements. The escalation of the 20-point plan in Gaza that leads to the Arab security forces, and concessions probably around the Strait of Hormuz for privatized elements of the financial industrial complex in order to tie it together so that the strait doesn't close again in case hardliner factions are able to do this. It will be done over a tiered structure, likely with strategic points, and it will be significantly better and significantly easier to maintain than JCPOA, the previous agreement that Trump tore up. And this will be worse for American interests and significantly better for Chinese interests, the BRICS corridor in general, and the GCC in general. US will not have the constructs that it needs to prop up the petrodollar. It will have a non-military industrial complex funded Israel that's not there to agitate war for the forever war. The US bases will be renegotiated into more favorable terms and a weaker US. US will exit the region in the name of the border peace. And that will be effectively what all of the things that I said that need to happen to achieve peace in the Middle East. Normalization between Iran and Saudi Arabia, resolution to the Palestinian cause, and the exit of the US. I thought it would take longer. This is accelerating a lot faster than I imagined. And I think it's, if it wasn't for war and tragedy, I think it's very skillful realpolitik that's being executed right here. So in summary, week two, we had the limits of the war revealed in terms of escalation cycles. We had massive disruption from the Strait of Hormuz. We had alternative pipelines that were able to soften the impact. We had no escalation from the Gulf countries on Iran. We had new relationships and infrastructure contracts and shipping agreements that are going to be able to be negotiated right now. We had shipments that US have not been able to get through despite rhetoric. We haven't seen any war in terms of naval ships, but we have seen enforcement through insurance contracts and posturing and various guarantees. We've seen Russia significantly benefit, strengthening its position in the BRICS corridor. We've seen US strengthening the dollar, strengthening its LNG dependencies with Europe, but in terms of leverage, but that doesn't last because we've seen the stress in the financial markets and how it can't handle an increase in the price of oil. And so we get a financial market reset that has to be executed quickly, that can lead to a big print and create the next narrative framework in order to weaken the dollar and return to the fiscal dominant strategy. And really, that is the conclusion of week two. It's still saying to me that despite the fact that I couldn't get the predictions right in terms of all the different details, the trajectory is the same. And I've learned a lot from it as well that I'll be using in future analysis. If you subscribe to my channel, if you like this video, we'll create AI summaries of this on my blog on simondixon.com. You can also make sure you follow me on Rumble. Make sure you subscribe to me if you want to download this as a podcast on Spotify and Apple Podcasts. And also follow me on X, where I give the real conflict as well. But I think we're still on track. But this is a managed and a recognition of global routes to usher in this multipolar world. I will keep giving periodic updates, and I'll check in for week 3 in terms of deciding whether something changed it. But I'll be following these pipelines. I'll be following oil. I'll be following these choke points.